All right. My name is Chris Campbell. I'm a practicing CPA, and I work with small and mid-sized businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. I wanted to talk a little bit about the pass-through entity tax. Now, I had spoken about this before, and I guess for those that haven't seen my other content about it, just to give you an idea. So, pass-through entity tax, I'm going a little bit of a history ride here, was passed, and it's a state level thing. So it started to get passed by most states, I'd probably say around 2019. But if you go back to President Trump, his first term, where he had these sweeping tax law changes, not the recent one with the second term with Big Beautiful Bill, the first one he was in his first term. There was a large, I think it was Tax Cuts Jobs Act or something like that. So nonetheless, when it was passed, there was a limit. Part of the changes was a limit on the amount of taxes that one could deduct on their personal tax returns. So it was limited to $10,000. So in the past, prior to that, if you paid whatever you paid with property taxes, state income taxes, all of those things, for the most part, were deductible on your federal tax return. So whatever you paid in state income taxes, whatever you paid in property taxes, all of that, for the most part, counted as deductions. There were some limitations based upon your income, but nonetheless, a good amount of it was factored in. So when that was limited to now only $10,000, you had a lot of higher income earners saw significant tax increases because of that, because you're normally paying more than $10,000 in the state income tax. And that included local tax as well. So let's just think about folks that have local taxes. So for example, just closest to me, New York City, you live in New York City, you have to pay a city tax as well as the state tax. So for those that were high income earners, between state and city tax, you're definitely paying more than $10,000 a year. And then even if you go into the folks that had expensive homes or even large homes, or depending on where you are, sometimes it doesn't even need to be that large, but you have a lot of folks definitely paying more than $10,000 a year in property taxes. So if you're a high income earner and you have pretty high property taxes, it was quite the haircut for you with taxes that you were able to deduct. So here comes pass-through entity tax to help at least business owners. Didn't do much for W-2 folks, but at least for business owners that were involved in either S corporations or partnerships, a lot of states started passing or introducing the pass-through entity tax, as a way to circumvent the $10,000 limit. And basically, the state would allow either a partnership or a corporation to essentially pay the state taxes through the company while acting as a deduction, at least on a federal level. Because as many of you that may operate partnerships or S corporations, the whole idea is that these entities don't pay income tax, the owners do. And the owners pay it based upon their level of ownership. So prior to this pass-through entity tax, they didn't pay income taxes, but the state started introducing this as a way to, again, folks to get around the $10,000 limit. So the taxes that you would have had to pay personally, the company is paying for it. And then at the same time, being able to get a deduction for it on your federal taxes. That was the way around it. Now, again, this is for those that participated as partners in a partnership or those that had corporation income. So if you're a regular W-2 person, you were still pretty SOL as far as being able to get around the $10,000 cap. But this was the way around it. So there is the history part of that. So once that came out and a lot of states started passing, usually by the time about 2020, 2021 came about, pretty much all the states that were going to do it had already went ahead and passed it. And it became a tremendous tool for a lot of my business clients. Two birds, one stone, so to speak. So you pay your personal state taxes, so you don't have to worry about a bill on your personal taxes, and the company absorbs the cost for it. And at the same time, it lowers your overall federal bill. So I was able to do some great things planning wise with my clients to save a lot of money in taxes with that. Worked out pretty well. Okay. So now we fast forward to present day. So now we're in, as I'm filming this, we're in Trump's second term. And one of the first things he did was he passed another tax law, right? So now we look at one big beautiful bill that got passed in 2025. What that did, at least in how it pertains to this pass-through entity tax, is that $10,000 limit is now going up to 40,000. So the deduction is a bit more generous, right? Because now that it is a bit more generous, there is still an income cap. So as long as your income is under about 500,000, you can still get up to about the $40,000 cap exists. So it's pretty generous. Now, the effect that it's had now is now a certain income level of folks, I'd say if your total income is, I'd probably say between that 250 the 500K mark, questions now come into play whether it actually makes sense to do the passive entity tax. This is something that I've been calculating with my clients, is that if they're within that band, that 250 to 500 band, we're calculating to see if it actually still makes sense to do the passive entity tax. Because before, with the cap being $10,000 being so low, and now that it's gone up to 40,000, depending upon how much the person would owe in taxes, they actually may get more bang for their going back and not doing the passive entity tax and actually just paying out the taxes on their own. Because keep in mind, the passive entity tax is optional. It was always optional. So it wasn't something that you always had to do. If you wanted to continue paying, you were normally paying your state taxes on the person, there was no law against doing that. So you can still continue to do it. It was a pure option. So it's just that when the cap was 10,000, it always made sense to go ahead and take that deduction. What I'm starting to see now is now that cap is up to 40,000. I've actually been seeing some scenarios where it actually doesn't make sense and you actually save more by not taking that passive entity tax and just paying it on your own. Because, we don't have to worry about those taxes being limited. If you're in a situation where if you add up all taxes that you would have had to pay between property tax, and it's mainly property tax. So if you're a homeowner and you're paying your property tax and you're paying your income tax through your company, if you're staying below that $40,000 mark, it might make sense to just go ahead and do that. And it varies from state to state. The point here is that if you are participating more so in an S corporation versus a partnership, where you'll really see those savings, maybe not as much because partnership income is still subject to the self-employment tax. So the saving on the self-employment tax might be worth it just by itself. But also with the those that are in S corporations, take a look at, or whoever is working on your taxes, take a look and see if doing a pass-through entity tax still may make sense. Because again, I've run into a couple of situations with my clients where it didn't, and we were getting ready to do it. And I ran a couple of scenarios for them. I said, oh, this doesn't quite make sense. And it varies from state to state because every state calculates that credit differently. So some states give you direct credit for the taxes that you paid. Some states will just give you quote unquote a deduction based upon that income that you've already paid taxes on. So it's not a dollar for dollar credit. You also have to look at different tax rates because most states, there are some that have regular flat taxes, but for those states that have sliding scales, you got to take a look, see if that makes sense versus what the passive entity tax rate is, because for the most part, it's really just one rate. So there are a couple of things that come into play, and I'm not trying to get too complicated here, but the point of this was that the passive entity tax may not necessarily make sense anymore for some taxpayers. So take a look at that, or ask a person who's working on your taxes to take a look at that, make sure that you are optimizing, because with this new big beautiful bill, this is the first tax season where these laws are in place here. Some of the strategies you might use before may not necessarily be optimal now. So that's the takeaway from the story here. So hopefully this was helpful. So that's all for now. And if you have any more questions about this topic or any other tax or accounting related questions, here, and I'm happy to help. So that's all for now, and I'll talk to you in the next.